Hello and welcome back to another episode on the Property and Lending Podcast. Joined with me, as always, Fadi and Mark from Power Loans. How are you, boys?
Yeah, we're good. We're not joining you. I think you're joining us from Bali, but
This is a special episode, but this is how committed we are to the podcast. You know, no matter where we are in the world, we
yeah.
find a way to bring value to our listeners. So,
Are we funding the hotel behind you? Are we purchasing it or?
Power Loans is actually paying for the whole trip. This is a business trip. uh, how's it going in Sydney, boys? I heard it's nice and sunny.
Yeah, sunny for a change.
It's still
Yeah.
cold, but it's getting sunny, and then hopefully the grass goes in this weekend for me, so I don't have a pond in the back no more. So
Beautiful. It's okay here. It's like 30 degrees. This is the first time I wear a shirt all week. Anyway, back to property. So today we thought, we'll discuss I guess, continuing on with the theme of, the buying process. After we've found a deal and whatnot, what do we do next? And due diligence is a big thing. And a lot of people sometimes skip due diligence. They're not sure what they're doing during due diligence. But it's probably one of the most important parts of buying property. So, well, let's talk about it. So, apologies about the so the first thing I guess is like a contract review, whether there's a finance clause or a finance review and building a pest. So we might break that down and go one by one about what we should be doing due diligence and what we should be looking for. I think the first thing once you get a deal and you get that contract is you got to send it to your broker and send it to your solicitor, and for two different things. So your solicitor will be looking at your contract and reviewing the ins and outs about a contract and making sure it all makes sense and there's nothing funky. And we're trying to get a solicitor on, so we might not spend too much time on that part because they'll go through it. But when it goes to you boys for finance, what are you guys looking for? What are you guys doing? What's happening at that stage?
yeah. So when the clients either sign the contract to sell, or we're hoping they come to us before auction, but let's talk about them actually just putting the 0.25% deposit down, or in other states where they put a deposit down, and I think you'll go through later on in regards to the finance clause. But us mainly, it's all about the security. So we obviously have postcode restrictions as well for most lenders that we discuss with our clients as well as part of the process of getting the pre-approval. But we send that contract to sell ASAP. I think, from experience, KM, once I get that contract to sell from yourself, for example, for a customer, the first thing I'm doing is ordering a valuation. Obviously, checking the postcode is fine. It's in a rural area, etc. We order that valuation to get that ASAP, so you give us enough time to come back in time. And then we also send it off to the banks to make sure that they approve the security as well. And from then on in, obviously the conveyancer does their part. We won't go into too much of that, but they, I guess, order the pest control that you have a lot of experience with now as well, which at times, and I think Mark, with your customers as well, where we've done a pest control, it's come back and it's actually given us a bit of a, KMU to negotiate a better deal, I guess, in regards to the price. And that's when we end up doing a deed of variation.
So I was just muting myself for the background noise. Okay, so when you guys, I think the valuation is probably the most important part. When you're ordering a valuation, what's actually happening? Someone going out to see a property? Are they just checking it on a computer? Is it what's the process and what's the desired outcome? Like, what are we trying to get from that?
This is funny you mentioned it. This was one of the things we spoke about recently at Flex as to why you need to go to a broker, not a bank. Every bank sort of has different policies with their valuations. Some banks, won't say any names, but some banks, for example, will come to mind where every single security in their book must have a full valuation done. Every single security, even if the loan compared to the value of the property is 50%, they'll still send someone out there. Then there are some other lenders. The more traditional sense is if there's no LMI involved. So if you're a first home buyer under the government scheme, for example, with a 5% deposit, there's no LMI. or if you're putting a 20% or with some banks 15% deposit down, that's considered to be a bit of a safer deal. So they won't physically send someone out there. What we end up doing is we order a desktop valuation. So that's just automatically generated and checked with the team before it comes back. That's also that's the best case scenario, because that always comes back 90%, 99% of the time comes back at contract price. And the reason why people need to go to brokers, not banks, is because recently, as of maybe the last 6 months, we've started to see this. Some banks actually, if you're buying at 80% LVR, the loan compared to the value of the property is 80%, you're putting a 20% deposit down, they will actually just go off the contract price. We don't even order a valuation. Sorry, correction. We actually order a valuation, but it automatically says go off contract price. And very, very, very few banks started. Like one bank came out beginning of this year with that, and now a few more have followed. But for people going to auctions, that's huge, because there's no shortfall. There's no chance of a shortfall if you're going that route.
So it really comes down to, I think the major one is the LVR, the loan to value ratio. So if you're not a first home buyer and you're paying that LMI, I think we've discussed this before, once it hits that LMI territory, which is the lender's mortgage insurance. So if you're putting anything under a 20% deposit, or if you're not in the government scheme as well, we're then dealing with a third party, not the banks. The banks is in one party, and then the lender's mortgage insurance is a third party. And they would, most scenarios would want to push towards that full valuation, especially in this sort of climate, this sort of environment that we're in now. I think, Mark, during COVID, we didn't see a lot of full valuations. We just went off contract price because everything was just peaking, let's say, during COVID. So we didn't see too many full valuations being done because no one was going out. They were just going off contract price. But in this environment now, where things getting a little bit more stricter, the borrowing capacity is, going less and less, and there's higher risk, if you would say, in regards to the banks that are doing their extra checks. Once it hits that lender's mortgage insurance space, it really isn't on the bank no more. The banks will obviously push for it if it's above 90%, but it's more the lender's mortgage insurance pushing that full valuation to make sure that they are covering all grounds as well.
So with the full valuation, so a couple of questions. With the full valuation, someone's obviously, a valuer is going out to the property and is actually having a look at, the fixtures, the features, the quality of the design, quality of materials, quality of construction, whatnot. Or are they literally just walking in, walking out? Or is it a genuine full check and, line by line, what does the property look like? And then getting a valuation based off that.
So I think they're going off comparable prices as well in the area, especially in whatever market that we're in. So everyone needs to keep in mind, a valuation only lasts for 3 months. Every 3 months, a valuation needs to be done. So if we get a valuation today on the 27th or in July, for example, 3 months after, that valuation is no longer, we're no longer able to use that valuation. There are 1 or 2 lenders from memory that will allow 6 months for the valuations to stick. But in 90% of scenarios, most banks will stick to 3 months only. Now, when those valuers go in there for a full valuation, again, it comes down to which valuation company we're going through, which valuation firm we're going through as well. We sometimes get some detailed valuations coming back. You find from JLL, CBRE, where they come back taking photos, showing photos, comparable prices at the bottom as well. And then sometimes we just get a valuation back going off comparable prices in the area. The valuer has gone out, check that it's a standing home, check that, it's livable, etc. And they'll just go off comparable prices where at times, KM, and you would know this especially, where we can actually go back, if the valuations come back short, we can say, well, wait a minute, there's a house down the street you're comparing it to, which is nowhere near up to par that this house is up to. And we, going back and fighting, not so much fighting, sorry, negotiating to try and get the same valuer out there or a different valuation firm to go out there and try and value the property at contract price.
Just on that, how often can you actually debate with valuers, and do they listen? If the valuation came in, you both are laughing. So
this one's on Mark because I can't keep my emotions intact. So Mark will answer this.
If a valuation was to come in under contract price, how often are you able to actually, how successful are you generally in getting a reviewed valuation? I'm trying to pick my words here. I'm just going to end the question there and let you go, Mark.
Well, I mean, the first thing we would do before even calling the valuation, like the valuer themselves, because there's never usually much luck doing that. I mean, there's what we would do. What we'd prefer to do is go just through a different bank. So if we sort of apply through Bank X to get the loan initially for the purchase, Bank X will elect the valuer. We actually don't choose them; the bank does. If that valuation comes back short, we go to Bank Y. We get them to send a valuer if they have to, if they can't do desktop, and it's much better, a much better chance of success. That the valuation comes back at the contract price, the more valuations you do, rather than contacting the valuer and sort of arguing with him, given that this is what he does day in, day out. They usually don't like being questioned. So, yeah, the more valuations, the better chance.
We should reach out to some valuer friends, see if we can get one on the podcast, and see what the process is. Just regarding that, so the optimal outcome, I guess, for the valuation to come back at contract. Are there any? What happens if the valuation comes in under contract price, and is it possible for a valuation to come in over contract price?
In the scenarios where the valuation comes back under, it really, again, it comes down to the LVR. So if we're purchasing a property at 95% LVR, including LMI, or 95% in general, they're going to have to cover that difference. But if we're purchasing a property at 80%, we've got that wiggle room. If the customers don't have extra funds to cover that difference, they've got wiggle room to go up to the 85, the 90, the 95%, without having to put their own funds in there to cover the differences. So we just increase the LVR. But in any case, if we're borrowing at a high LVR, a higher loan to value ratio, unfortunately, the customers are going to have to cover the differences, which is the last resort. Like we never want to be put in that sort of position. And that's where you'll find Mark and I, or brokers in general, to be honest, fighting. Like Mark said, it's a lot more easier to try and order a valuation for another bank instead of going back to the valuer to have that discussion with them. Because I guess in anything, man, I don't mind admitting fault or admitting wrong, but I guess in anything, people don't want to be told, no, you didn't do that right, or no, we don't agree with you. So it's a lot more easier to try and go to those sort of lenders that, you know, brokers have access to order those upfront valuations or order a desktop valuation or wherever it may be, instead of going back and trying to argue with someone that, like Mark said, but they do it on a daily basis, and it's going to be, I mean, what BDMs say, pretty hard to change their minds as well. And at the same time, we can try and get our BDMs to get more of an exemption to try and order another valuation for another valuation firm.
And
yeah,
when I was just going to say, when Fadi was saying about the if you're under 95%, we can just sort of, that shortfall, we can just try to see if we can add it on top and then get the LMI capitalized as well. That's assuming that the servicing works out. So if you're buying at 80% LVR or even 70% LVR, and there's a shortfall, meaning the valuation comes in lower than the contract price, and you've already hit your max, you can't service any higher debt, then the rest would have to be paid out of pocket, unfortunately. But in that case, like I was saying before, we would try to go to a different lender and see if the valuation comes back at contract price. Then obviously that would be the best case scenario. But as Fadi was saying, we can escalate with the bank as well and see if there's another alternative there.
And keep in mind, when these valuations are ordered, it's like a panel. Each bank have a panel of at least 10 valuers on their panel. The banks don't actually send it out to a specific valuer. The banks will just put it out there, and whoever picks it up first, basically, which valuation firm picks it up first, they're going out there to value it. So the sucky thing is, I've been put in a scenario where I've ordered a valuation for one bank, gone to a second bank to get another valuation. It was actually picked up by the same valuers, which we have no control over as well. So it's just, I think this kind of outlines why you need to go see a broker, because if you go directly to a bank, they're going to have to order the same valuation throughout the same branch, for example. But with a broker, they've got over 40 lenders with most brokers out there these days. They can order that valuation for them and try and get close to the contract price.
And also, that's also the reason why it's very important to go to the solicitor as well, because if you have the correct clauses in the contract, you're saving yourself. Because if there's a shortfall of 40 grand and you can't come up with it and you can't service that extra debt, then you can sort of pull out with only sort of losing a 0.25% deposit, which is only a few grand in New South Wales. Alternatively, you can leave with a refundable deposit if you went through the right process with the solicitor and got the favorable terms. This is assuming you didn't buy at auction, of course.
Yeah, that's a great point. I was just going to mention that as well. I was going to say, I guess that's the importance of your due diligence really starts before you've even purchased the property by surrounding yourself with the right team. And I would say you're right. The right team is your accountant, your mortgage broker, your financial planner, your solicitor, and the buyer's agent. The buyer's agent, from my perspective, we do so much research prior to purchasing a property on the actual property itself that we know the property price, we know the valuation of this price of the property, and we know we're not going to go over the valuation. It's very rare that we're going to have a valuation issue. Whereas if you're not actually sure what the property is worth, and you're just going off what the real estate agent is telling you, which is always going to be more, the real estate agent doesn't care. If the house is worth 500 and they sold it to you for 900, they don't care. But you're not going to be able to pay for it, and you're going to lose your deposit, and they'll just sell the property. And so it's very important that you surround yourself. I think the due diligence starts before you even start buying property. Surrounding yourself with the right team to make sure you don't run into problems. Because as you were saying, Mark, if you're short, 40, 50,000, that's a lot of money. Like it's huge money, a huge amount of money. If you don't have it, you're going to lose something. You're going to lose some sort of deposit or whatnot, unless you've obviously got the right clauses in there. Just if people are not sure, because I know a lot of our listeners are Sydney based or New South Wales based. In Brisbane, for example, have a standard in your contract. You don't have to pay this. Standard in the contract, a finance clause, and essentially the finance clause is 14 or 21 days, where you have that time for the broker to get the finance from pre-approved to an unconditional. So get the valuation done, make sure all the documents are all good, and whatever else you need to do. For essentially 14 days or 21 days, for the bank to say, okay, we've assessed it, everyone's happy, we will give you the funds. If you don't get the funds in that time, you can pull out of the contract due to not the finance clause, and you don't pay a deposit, or if you've already paid, the deposit is refundable. In Adelaide, this is the same. You got the same clause, 21 days. There are different states have different time periods and whatnot. In New South Wales, you just have obviously your normal cooling off period, but you cannot pull out due to finance. If you want to pull out because your finance didn't come through, you will lose your 0.25%. Whereas in Sydney, at Brisbane and Adelaide, for example, you actually won't lose a single dollar. You gotta get that back. Just quickly before I move on, in what scenario, what happens if the valuation comes in over? Does it happen? Is it like extremely rare that the valuation comes in over the contract price? I know me and Mark had one mutual client where the valuation was higher, $50,000. But does that usually happen, or is it very rare? And if it does happen, what does it mean?
I think we've seen it happen, and prior to COVID, I've never seen it happen. Prior to COVID, the bank's never, ever going to value it higher than what the contract price is. So, and it's a good question. So in last year, we had a lot of people purchase off the plan, home and land packages, where now they're ready to construct. Just an example, we had a customer that purchased altogether home and land package for 704. The valuation for the whole building early this year, came back at, I think, 892,000. Now, the customers straight away asked, oh, awesome, so we're now below 80% LVR. No, the banks don't see it that way. Even if the valuer is valued at higher, the banks are still going to go off contract price. And just to play it simple, the banks are not here to do too many favors for you. They want your business, but whatever you purchase that house for on the contract price is what they're going to value it at, whether you got a higher valuation or not. Unfortunately, yeah.
Yeah, I mean, in my time, I bought and purchased a lot of properties, and you guys have obviously done a lot of loans. In my time, I've only ever had 2 properties come over the valuation, over the contract price. So I think it's very rare. I don't know how many times you guys have seen it, but I've seen it twice. And
What
I
period
guess
was that in,
just,
KM? Was that in the COVID period as well?
well, one was post-COVID
Yeah.
with Mark, mutual with Mark recently, and one was prior to COVID. That's it. I've only ever had two come over contract price. And I guess, I mean, it doesn't really make sense from a bank's perspective to, to value it more than what you pay. If you're paying 500, then I'll go tell you, hey, it's 550. Here's enough extra 50 grand to go buy a car or something. But I guess it's just it's a nice confident sign that you've purchased a property and there's extra money to be made. 6 months later, you refinance or something, you've got some immediate equity.
Yeah.
Is that the only benefit? I can't think of anything else really.
Yeah, well, you're right there, is that after a couple of months, if you're looking to refinance and purchase your next investment opportunity or another property in general, you're pretty much right. After a couple of months, they've got that extra equity that the bank has valued it at a higher amount. And if anything, after a couple of months, you'd think they would probably value a little bit more higher than that valuation as well. And those scenarios, they're rare. They're rare scenarios. They're scenarios that we all want to be in, but they're rare scenarios. Yeah.
Any other comments on finance clause before we move on to the next step?
I think one thing that we had at Flex the other day as well, when we're doing the talk there, is which bank should we go through, or is there a specific bank that we need to go through, or shouldn't I go through the big four banks and the second or third tier lenders that I haven't really thought about? And I remember we got asked that question, and my response was, a bank's a bank at the end of the day. Each bank does the exact same thing. They want to give you a loan with a rate, and they want to keep you in that loan for 30 years or longer. So honestly, it just comes down to the biggest advantage, again, going to a broker, is that we're solutions. These second or third tier lenders, some of them will give you a higher borrowing capacity than the big four banks. And some of them are a little bit more lenient with their policy as well in regards to how they read your income, especially in regards to self-employed as well. It's a big advantage. So it really comes down to the best bank that fits your position or fits your scenario, basically.
Cool. So next step, usually not the next step, usually in conjunction at the same time, whilst your broker is working on the finance part of the deal, we always recommend doing a building and pest inspection. Regardless of the age of the property or regardless of what you want to do to the property, even if you're going to knock it down, we always recommend doing building and pest because you just don't know what's going to come up. And when you're buying a property, 3, 4, 500,000, a million, 2 million, 5 million, for a $500 report, you could be saving yourself a lot of money. So building and pest inspection, obviously, you hire a company, qualified building and pest inspectors, and they go out to the property and they literally assess everything. They look at the building from a cosmetic perspective, a structural perspective. The pest inspection is looking for termites. Recently, one of the companies we use has been doing meth checks to see if there's the properties that we use to make meth, crystal meth, the drug. I'm not sure why, like that specific drug. I'm not sure, like maybe there's a builder listening that can tell me if crystal meth has a adverse effect to the building's integrity or something, or when you're making it. But and that $500 report though, essentially what you're looking for is to see if the property is in good and livable condition, if the property is structurally sound, and if the property has termite damage. Really, those are the two major things that we're looking for: structural issues and termites. If you have structural damage, it's very difficult to fix a lot of the time. If you're talking about like the floor has moved or the walls have moved, or you've got a crack, like a big crack in a structurally holding wall, something like that's important to the integrity of the house, this can cost you a lot of money to fix, as opposed to we're not really worried too much about there's a few scuff marks, or you need to do an extra paint this area, there's a hole in a wall, whatever, someone's punched the wall. That the cosmetic issues can be fixed pretty easily. What you're really looking for is those structural issues, and then termite damage more specifically, because termite damage can kill a property, really quickly. These are things that you will not know when you're doing a visual inspection. When you go to check out the property, even if you're a builder and you're checking out the property, like on a Saturday inspection, and you're walking through, you're not actually checking the property. You're just having a look at the cosmetics.
And prior to auction, that's a question. Prior to auction, are we able to order a pest control prior to auction?
You can order a building and pest inspection whenever you want.
And the real estate agents are fine with that. They're fine with just letting someone through. Yep.
They can't really say no to it, to be honest. It's part of the process. Building, when you're buying at auction, you have to do it prior. You don't have an option. You can't do it post, because once you've bought the property, there's no cooling off period on auction, right? So you've paid your 10% deposit. So you can do a building and pest inspection after you find out that the house is fully over. You bought the property for $1 million. You've paid 100K. So you can pull out, but you're going to lose $100,000. So for a $500 report, you can save yourself literally $100,000, give or take. So different states again will have different times where we do the building and pest inspection. In New South Wales, generally, the building and pest inspections are done prior to entering into a contract. You do have your cooling off period in New South Wales, so you can do it after, but you will lose your 0.25% deposit if you pull out of the deal based on the building and pest report. In Brisbane, as we were mentioning with the finance clause, or in Queensland, you have the same thing. So you can actually, Queensland is kind of the best state in terms of protecting the buyer. You have your finance clause 14 or 21 days, and building and pest inspection. Usually we just do 14 days or even 7 days on building and pest to make it more for the vendor. But it's plenty of times to get a building and pest done. But essentially in that 7, 14, 21 days, whatever it is, if the building and pest comes back with issues, and it's so ambiguous to be honest, because it could be cosmetic issues, and if you don't like it, you can walk away. But really, it's there for if there are structural issues or if there are major issues and you cannot come to a resolution with the other side, the vendors, again, you can walk away and say, I don't want to buy the property, and you don't lose anything. If you've paid the deposit is refunded as well. So in Adelaide, you actually don't have a building and pest clause. And in Adelaide, your cooling off period is only 2 days. So in Adelaide, we have to work very quick when we get a deal. Whenever we get a deal in Adelaide, building and pest inspection is organised immediately. And but the building and pest guys in Adelaide know that you don't have time, so they get the reports out to you the same day. They go and they get it to you because they know you don't have any time. So in Adelaide, you can't pull out due to building and pest, but you've done it during your cooling off. And in Adelaide, you don't pay a deposit till after your cooling off period has ended. So if the building and pest had problems, you can walk away. The major thing though with a building and pest is doing the report to make sure there are no problems. I can't believe how many people buy properties without doing a building and pest report, and it's just crazy. Like when you go buy, when people buy a car, they check it. When you go, when people buy clothes, they don't buy. They go to the shops to try it on because they want to make sure it's fine. You're talking about $50 item or something. Here you're talking about a potentially multi-million-dollar property, and for $500 peace of mind, it's crazy that people don't do it. To be honest, we just purchased a property that's only been around for like 6 months.
Yeah.
It's getting new property. We did a building and pest inspection. We are expecting nothing. We're doing the inspection, expecting no issues. But if there is, you want to know about it. And I always compare it to like insurance. Insurance is something you have, but you never want to use. But when you do need it, you're happy you got it. And the building inspection is the same. You're doing the report, hoping that there's nothing there, hoping that everything is okay. But if there is something, you're glad you've got the report. Because from that point, you can start negotiating with the other side. It doesn't mean, if there is something that comes up, it doesn't mean it's all over. You can negotiate with the other side to fix the issues or to reduce the contract price by how much it's going to cost to fix. It doesn't mean it's all over. But definitely from a structural perspective, like part of your due diligence, every single property should have a building and pest inspection performed on it, 100%.
And in regards to What, 2, 3 years ago during the COVID period as well, when you're going to buy a house and real estate agents didn't give you time to breathe before making a decision. You had people purchasing those properties, trying to, basically pin it down and take it for themselves, and then do a pest and control, check.
Building pest inspection, yeah.
Yeah, but isn't that scary? Like now, just thinking about what you just said, is that during that time, people had to be on the phone. Yeah, we'll take it for that amount. And also they were signing 66W contracts.
Yeah, for sure. And I mean, we still see it now today. Like we're buying in, obviously Adelaide is one of our hotspots at the moment. And in certain areas, the property is not up for sale more than 24 hours. And after 24 hours, the property is sold for 50,000, 100,000 more than it's worth. And if you start adding clauses, I want to build the impress clause, or I want this and that, you're no longer as valuable to the vendor as someone who's unconditional, who's just like, I'm ready to buy this property no matter what. But you should still, we have never purchased a lot of properties, and every time we buy a property that's in a hot area, that's what we do. And we have never purchased a property without a building impress inspection. You just have to, if the vendors are not willing to listen or to take into account your requests for building impress, you should not buy the property. Doesn't matter how good of a potential deal it is, because that potential deal that's $100,000 or $50,000 undervalued could end up costing you $500,000. If the entire house needs to be knocked over because there's a huge issue, you've lost the house.
Yeah.
And it can be as extreme as that. It can be as extreme as the footing has been moving, or all these properties in that western southwest Sydney suburb, Spring Hill, was it, where the floor is caving in on itself. All those houses are going to get eaten up. No one did not one person did the pest inspections to find out the floor was no good. The ground, the soil was no good. Those houses are literally eating themselves. So it is tough for a buyer in a hot market to request these things around it. So, for example, in Brisbane, because of your building and pest clause, I always let's get the deal done and then do the building and pest inspection. Worst case, there is a huge problem. When you walk away, you spend $500 on a building and pest report. Much better than not doing it, and then spending, hundreds of thousands next year. In Sydney, during the hot market, we do it the other way around as well. We'll get the deal, and then we'll do the building and pest during cooling off. It does depend. You have to work with the market. So if it is a hot market, you've got to work with it. And if that means doing the building and pest during cooling off and potentially losing 5%, that's the way you got to do it, unfortunately. But yeah, it's just crazy. Like, not doing a building and pest report. It's peace of mind, buying a house and you know that the house is not going to fall over while you're sleeping.
Yeah.
And that might be the reason why, like, as in, if you have a vendor that is reluctant to do the deal with you, if you want that clause, that might be, like, they might know that something's going to come up from the report. So, like, I guess that may be a red flag that you need to look out for as well.
Yeah, definitely. With definitely, like with older properties, if the vendor is not keen, there's usually some reason for it. Then you do the building and pest report, and like the entire subfloor has been eaten up by termites, and like at any moment the whole house is going to fall over. So, just on that, just a comment on reports. If you've never done a report, if you've never seen a building and pest report, though, it can look very, very scary. And just like a word of warning, like a building and pest report can be 50, 60 pages long, and there's nothing wrong with the property. The person who is conducting the report is protecting themselves first and foremost. So they are going to report on everything. I have literally seen comments like, a bit of the from the landscaping has gone over onto the driveway, and this could cause like slipping and could cause damage and injury. Like, that's obviously stuff they don't care about, but they're protecting themselves. So you have to read between the lines and see what's important and what's not. A lot of it is cosmetic, and that's fine. That you can negotiate. You know, if you need a paint or do some patching, whatever. You could quote it up and say, okay, it's going to cost 5, 7, 10 grand. Speak to the other side, say, hey, either fix it or knock off 10 grand from the price, and we'll fix it. And I usually prefer that method as opposed to the vendors fixing it, because you're in control. You can pick your own tradies or builders or whatever. And if you don't really want to do it, you don't have to. You can just knock off the money, as part of your negotiation. But I always would say you have to be fair with it. If you start being unfair with building and pest negotiations, the agents know, and they won't work with you. And I always think you have to be fair with everyone. If the agent's been good to you and the vendors are good to you, you get a good deal. And there's very, very minor stuff. Sometimes we don't even bring it up. It's not worth annoying someone for a few $100s or $1,000. It's not very nice. It's not very fair. But if there is major issues, of course, we bring it up. But just with the reports, you got 50 pages, and sometimes there's nothing wrong with it, so you don't freak out. And a lot of the times, what you should do is actually speak to the builder once the report's back. We always call the builder who's done a report and say, mate, Neil, Noel, Joel, whatever your name is, thanks for the report. What do you think of the property? Often over the phone, they might tell you something different sport because, it's not legally binding and they're a bit more relaxed. And they might say, look, property's fine. You just need to fix, this or that, and you'll be right. And when you read the report, it's like 60 pages. And you think the whole house is falling over, but really there's nothing there. So just a little heavier on investment.
And I was just going to say, I've actually had a purchase before where a customer bought without a building and pest inspection because they were going to knock down the property. So they didn't really care. They were going to demolish it anyway. And so they ended up buying, and the valuation came back from the bank, and there was a line from the valuer because they actually sent someone out there, and it said it's not currently in livable condition. Mind you, it looks fine in the pictures because of a wiring issue in the laundry. So if there are major defects, even if you are knocking down the property, the bank doesn't necessarily want to put their name on the property if you can't rent it out, which is what we're saying on the application to use the rental income. So yeah, that's the other thing as well.
Cool. I guess that's the main thing that we're looking for during our due diligence period is getting your contract reviewed, and we'll go through that with the solicitor on another episode. And then your finance, and then your building. Once you've ticked the contract, once you've ticked those 3 boxes, you're pretty much sweet. You're pretty much smooth sailing till settlement, and then I guess we could do another episode on what happens on settlement day. People only buy 1 or 2 properties in their lifetime, so maybe people don't know what happens on the day, the big day. But pretty much from that point, nothing's going on. If it's an investment property, you're organising. Pretty much it. There's not much happening. You're organising your finance, making sure your money's in the right accounts and whatnot. But yeah, you boys, any other comments on that?
No, I think we've pretty much covered pretty much everything.
Good. All right. Well, I guess that's a wrap. We'll call that an episode.
Yeah.
Until next week. Well, let's try and get a valuer on as well sometime in the future.
Yeah.
Because I think that'd be cool. I'd like to discuss with a valuer.
I'd love it.
have a chat with them, see what their thought process is.
Yeah.
But yeah, thank you guys for joining as always.
Yeah.
Thank you to our listeners for listening as always, and we'll see you next week.
Hey guys, thank you.